Comes to risk tolerance, it's very important that every family learn what's their risk tolerance. Now, your risk tolerance means that you got to know what's the difference between it being a conservative, an aggressive, a moderate, and a moderate growth. Because once you understand your risk tolerance, then you understand, yes, your money gonna always lose money. And I know what people must say, oh, what about dollar cost averaging, Coach Keon? What about dollar cost averaging? Now, I always say this, and I'm gonna say the same thing to you. You think dollar cost averaging matters when someone is retiring? Meaning that if the market dropped tomorrow and you're going to retire tomorrow, do you care that you're able to buy more stock, or you worry about the money that you need to stay retired? Which one is more important to you? The money that you need to retire or the opportunity to make more money?
The money I need to retire, I believe.
Yeah.
Because if you're making more money, but, it's not going anywhere, successful.
Heard of the rule of 72 before? So the rule of 72 is a concept that actually got me in the industry. It's why I became a financial educator, by the way. Because the rule said that if you take 72 and you divide it by whatever interest that you're receiving on your money, the equal represent the number of years it takes for your money to double for you or against you. So let me give you an example. Imagine that you're 29 years old and you want to retire 65, and someone say, hey, put $10,000 where you're able to get 2%. So you're going to take 72 divided by 2, that equals 36, which means that $10,000 will only double one time from 29 to 65 and only become $20,000. Let me ask you that. Is that enough money for you to retire on at 65? No. Now, imagine how much the bank is giving you. But not only just imagine what the bank is giving you, imagine how much the interest is on your credit card that's going against you, your mortgage, your car notes, right? Yes. And take whatever that interest is divided by 72. When it comes pertaining to life insurance, you want to ask yourself, am I insurable? Am I insurable? If you don't know your DIME, which stands for your DIME, your DIME method, you got to ask yourself every day, am I owning enough insurance? Am I insured enough, or am I underinsured? In this society, most of these guys only going to sell you life insurance based upon how much money they're trying to make. It's very rare you hear someone say, hey, let me break down your insurance need to you in this manner. The simplest method is called the DIME method, by the way. This is how the DIME method works. Let's say that you have a debt of $75,000. Let's say that you make an income of $50,000. At least 15 years of your income replacement. So that's 15 years of 50,000, which is $750,000 in income replacement. Let's say that the mortgage balance is at $275,000. Let's say that hypothetically you have 2 kids. Tuition is about $60,000 per year. So you need about $480,000.